Pennsylvania's real estate dream is cracking. But this isn't just a cool down, it's a real correction, visible in the numbers and even in the mood on the streets. Neighborhoods once considered untouchable are already seeing double-digit drops. The number of available properties increases every month, and the competition among buyers has practically disappeared. For those who invest with a method, this isn't a crisis, it's an opportunity. Larger inventories mean more negotiating power, longer sales timelines mean more aggressive discounts. And cities with diversified economies still maintain solid fundamentals for stable rental income. Before we continue, please leave a like and subscribe to the Keynomics channel. Here we talk about real data, market cycles, and the opportunities that no one shows in the headlines. Turn on the notification bell so you don't miss the next videos, and tell me in the comments where you're watching from. I want to know which U.S. state you call home. In the last 12 months, home prices in Pennsylvania have fallen between 8% and 15%, depending on the region. The number of homes for sale is up nearly 40%, and the average time to close a purchase has doubled. High interest rates, stagnant wages, and cautious investors have changed the game. But what many see as the end of one cycle is actually the beginning of another. For decades, Pennsylvania was one of the most stable markets on the East Coast, with slow but consistent growth supported by universities, industries, and healthcare centers. Now, even these safe markets are adjusting. Maintenance costs have risen, credit has become more expensive, and the profile of buyers has changed. Families are more selective, investors more rational. But it's exactly in this type of scenario that the prepared investor stands out. Because when fear increases, prices retreat, and that's where the best buys are born. Pennsylvania is correcting, but not collapsing. Unemployment remains low. Incomes in the service sector remain strong. And the universities and hospitals keep the flow of renters stable. In other words, the ground is fertile for those seeking dollar-denominated income with security and a long-term vision. So let's get straight to the point. The 10 cities in Pennsylvania that are offering the best investment opportunities before the end of 2025. 10. Bethlehem, located between New York and Philadelphia, Bethlehem was for a long time the picture of balance, an industrial city that reinvented itself through culture, tourism, and innovation. But in 2025, the market entered a correction phase. Average prices fell by around 9%, while the housing inventory increased by over 60%, the largest increase in a decade. This temporary oversupply put pressure on sellers but opened up space for strategic entries. Properties near the historic center with colonial architecture and a multifamily profile are trading 10% to 12% below their peak value. Even so, rental demand remains firm, supported by students, doctors, and tourists. The average gross return is around 6.5% to 7% per year, and municipal incentives for urban revitalization are expected to boost the downtown area in the coming years. Bethlehem is the type of city where an investor buys on the correction and sells on the recovery, with security, cash flow, and predictable appreciation. 9. Lancaster. Known for its mix of rural life and a modern economy, Lancaster is experiencing a readjustment after 2 years of euphoria. During the pandemic, the city became a refuge for urban families and remote professionals, which caused prices to skyrocket by nearly 40%. Now, the market is giving back some of that gain, with drops between 10% and 14%, depending on the neighborhood. But there's a differentiator. The local economy remains solid, especially in the health, education, and transportation sectors. Unemployment is below 4%, and the quality of life keeps the city among the most sought after by families. Today, homes that cost $400,000 are being negotiated for $340,000, generating a net cash flow of over 6% per year. And since rents haven't retreated, the return margin has become even more attractive. Lancaster represents the type of market that matures. It moves out of the frenzy and into the rational phase, perfect for investors who think long-term. 8. Reading. Reading is a living reminder of how the real estate market moves in waves. During the 2021 frenzy, investors bought in droves, inflating prices. Now, with demand receding, many of those same investors are selling in a hurry, and that's where the opportunity arises. Average prices have fallen 14% since the 2022 peak, and some neighborhoods have seen depreciation greater than 18%. But rents have remained stable, and the city offers cap rates between 7% and 8% on well-located residential properties. The local administration has been stimulating rehabilitation programs for old properties, with tax incentives for those who invest in long-term rentals. Furthermore, the arrival of small businesses and logistics projects in the region is reigniting the economy. Reading isn't for those seeking glamour, it's for those seeking real returns with appreciation potential. Here, profit comes from patience and the ability to see value where the market only sees problems. 7. Scranton, Joe Biden's hometown, is experiencing what many call a return to balance. During the pandemic, it became a refuge for those leaving New York and New Jersey in search of space and tranquility. But that flow has slowed and prices have returned to normal. Home prices fell by an average of 13%, and multifamily properties lost as much as 20% of their value. However, the city maintains stable rental demand, supported by universities, hospitals, and public sector jobs. The cost of living remains affordable, and the crime rate is lower than the state average. Properties between $200,000 and $350,000 now deliver net returns of 6%, and the municipality still offers tax exemptions for up to 10 years for those who buy and renovate properties in historic zones. Scranton is the type of city where quiet capital moves. No headlines, no bubble, but with consistent growth and low risk. 6. Erie is the city many ignore until they look at the numbers. Located on the shores of Lake Erie, it suffered one of the biggest corrections in the state, a 16% drop since 2022. Properties near the waterfront, which once cost $280,000, are now trading for $225,000 on average. At the same time, rents have risen slightly, driven by a lack of new construction. The result is a gross yield between 7% and 8%, with an upward trend. Erie has also been benefiting from state programs focused on port revitalization and energy efficiency, which should boost property values in the coming years. Local tourism, focused on summer leisure and events, continues to drive the economy, and the city attracts investors looking for affordable properties with immediate returns. In other words, Erie is rebuilding, and those who get in now get in before the next appreciation. 5. Allentown. Allentown was for years the symbol of Pennsylvania's recovery. Between 2020 and 2022, it attracted thousands of families from New York and New Jersey, boosting the logistics sector and raising property prices by up to 35%. But since the end of 2023, the tide has turned. Average prices fell 11%, inventory increased by 40%, and new developments began to surplus. This scared sellers. But for those who invest with vision, it opened an avenue of opportunities. Today, townhouses and multifamily homes in neighborhoods near highways and distribution centers are seeing discounts of up to 15%. And the best part? The city's economic base remains strong. Allentown is still one of the largest logistics and transportation hubs on the East Coast, with companies expanding operations even in a high-interest rate environment. This keeps employment stable and rental demand solid. In terms of profitability, properties offer cap rates of 6% to 6.8%, with appreciation potential as soon as construction slows down. Allentown is the type of city that is experiencing a pause, not a collapse, and this pause is the time an investor has to get in. 4. York. York is one of the most interesting markets in Pennsylvania right now. Located between Harrisburg and Baltimore, it has always been considered an affordable refuge for those who work in big cities but want a lighter cost of living. During the pandemic, this advantage turned into an explosion. Prices rose by almost 40%. Now, they are 15% to 18% lower, depending on the neighborhood, and the city is once again offering what attracts investors most: balance. Jobs continue to grow slowly, local tourism is recovering, and the region's schools attract middle-class families. The best opportunities are in single-family homes in areas close to highways, properties with good liquidity and appreciation potential. The net rental return is around 6% per year, and there are incentives for buying properties intended for long-term rental. Furthermore, York is becoming a center for small industries and startups, diversifying the local economy. When the national real estate market recovers, York tends to be at the forefront of the recovery. 3. Harrisburg. The capital of Pennsylvania has always been seen as a safe harbor. As the seat of the state government and home to a large, stable middle class, Harrisburg has weathered previous crises well. But in 2025, even it felt the impact of the correction. Average prices fell 13%, especially in the Uptown and Camp Hill regions. Still, the rental market remains extremely stable, with vacancies below 4%, supported by public servants and university students. The opportunities are in townhouses and smaller condominiums, which are being sold 10% below their 2023 value. For conservative investors, Harrisburg is one of the safest options in the state. Low risk, predictable income, and constant liquidity. Net yields vary between 5% and 6% per year, and appreciation is expected to keep pace with the local economic recovery. The secret here is simple. Get in before the complete stabilization, locking in the price while the market is still hesitant. 2. Quote, Pittsburgh. For decades, Pittsburgh was the example of American reinvention. It moved from steel and coal to become a center for technology, universities, and innovation. But 2025 brought a challenge: the slowdown of the digital economy. With layoffs at startups and pauses in hiring, the local real estate market lost some of its momentum. Average prices have fallen 17% since 2022, and properties in the Bloomfield, Lawrenceville, and Southside neighborhoods have accumulated depreciation above 20%. On the other hand, the education and healthcare sectors, the base of the local economy, remain firm. Universities like Carnegie Mellon and the University of Pittsburgh maintain constant demand for student housing, and the city's infrastructure continues to expand. Today, properties between $300,000 and $400,000 offer returns between 6% and 7% per year, with a low risk of vacancy. Additionally, there are new tax incentives for investors who renovate multifamily properties in the expanded downtown area. Pittsburgh is the classic wait and reap market. Those who enter now are looking for double profits when the tech recovery comes. 1. Philadelphia, the state's largest city and the economic heart of Pennsylvania. Philadelphia is at the epicenter of the correction, but also at the forefront of the recovery. Average prices fell between 15% and 22%, and the neighborhoods of Fishtown, Northern Liberties, and West Philly suffered the steepest drops. But what looks like weakness is actually a repricing that is already beginning to attract new capital. Philadelphia remains one of the most liquid markets in the American Northeast, with a solid base of employment, universities, tourism, and student housing. Institutional investors are already returning, buying entire portfolios at discounts of 20% to 25% compared to the 2022 peak. Mid-range multifamily properties, now between $350,000 and $450,000, are generating gross yields of up to 6.5% per year and expectations of double-digit appreciation by 2026. Furthermore, new infrastructure and urban redevelopment projects in the historic center are expected to reignite interest from the corporate market. Philadelphia is the type of city that, when it rises, pulls the rest of the state up with it. Whoever gets in now gets in at the beginning of the curve, not when it's already at the top again. Pennsylvania's real estate market is in a repricing phase, not a collapse phase. The numbers scare those who read headlines, but they excite those who read balance sheets. And the story is always the same. When prices fall and fear increases, real investors make their move. The correction we are seeing today will define who will be positioned when the appreciation cycle restarts in 2026. The next few months should consolidate the new price floors, and those who enter now stand to capture gains of 20% to 30% in capital and accumulated income within 3 years. In other words, it's time to act with calculation and confidence. Pennsylvania hasn't lost value. It has just returned to fair value. And it's on this more rational ground that the best opportunities arise. While many are still looking back, trying to understand what went wrong, attentive investors are looking forward to where the market will grow next. If you want to keep following the real opportunities in the American real estate market, turn on notifications, like this video, and leave a comment telling us which Pennsylvania city you'd like to see analyzed in detail in the next episode. And remember, investing is acting when the noise is scary, and reaping when the silence brings profits. See you in the next Keynomics video.